What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is October 1st of 2017. Well, folks, as you all know, if you keep up with my channel, you know that from time to time I like to share a trading tip with all of you to help you all improve on your trading and investing journeys in cryptocurrencies. And today I'm going to be talking about something that's outside of the norm of what I've talked about so far. We've talked about technical indicators on this channel. We've talked about the RSI, the MACD, the standard moving averages. And we've also talked about trading strategy. We've talked about how to know when markets are oversold and overbought and when to get in on certain price action movements. But today we're going to be talking about something known as technical patterns. Technical patterns of price action that can give us an edge on knowing where the market is going to go, or a certain crypto or stock asset is going to move over the next few days or weeks. So, that being said, what are we going to focus on today in the sense of technical patterns? We're going to be talking about wedges. Not only are they one of the most common patterns you'll find in markets, but it's a very powerful advantage you can have if you can simply spot them and know how to use them to anticipate price action in cryptocurrencies more specifically. So let's go ahead and take a look at a few examples to really understand what a wedge is at its core and what types of wedges there are out there so we can anticipate price action and make solid trades. So I want to go off by talking about a standard wedge first and foremost. Wedges are not very complicated. They're created using segments or line tools, whatever it may be, on your charting platform. And how you do this is through simply drawing two lines on price action that is coiling in, okay? Now what do I mean by that? As we can see here, we're looking at Safe Exchange Coin comparative to Bitcoin. And we can see that SafeX had a nice little run up here, but saw some resistance around 240 Satoshis. And then we saw a pullback pretty much right down back to the lows here. But surprisingly, it's a little bit higher. We didn't go down to the lows over here. And then over here, we had a run up, but it wasn't as high over here. And then the bottom gets a little bit higher. And the high gets a little bit lower. And the bottom gets a little bit higher. And the high gets a little bit lower. And I could go on for hours and hours saying that probably, and you go insane. But generally speaking, that's how a wedge works. It's when price action zigzags inwards and it coils in to a much lower price range of volatility. And when it does this, as we talked about in our Bollinger Band video, when the volatility, the movement in price action within a period of time, whereas the volatility was high over here, as it starts to shrink inward, starts to get a little more quiet, and it's waiting for that big breakout moment to the upside or downside. The wedge is slowly coiling in and waiting for a catalyst. It's waiting for something to push it above the wedge, the top of the wedge that's been holding down the price action, or push it below the supporting wedge, which has been slowly rising. So again, wedges are not exactly bullish or bearish. Now there are two types of wedges we're going to talk about after this that are bullish, where one is bullish and one is bearish. But in this case, wedges are not always bullish or bearish. They're showing you that there's going to be a coiling of price action and there's going to be a big movement to the upside or downside. Just knowing this, though, will give you a very good advantage to be able to make trades. So how's an example of that going to work? Well, what we can do is we can do either two things. In most cases, most of you out there are buying, okay? So what you could do is buy somewhere in this range, and you could set a stop maybe for 120 Satoshis. And if it goes down to 120 Satoshis, if it starts really breaking down to the downside, you got stopped out, didn't work your way. Or you got inside the wedge and it broke out to the upside and you had this huge kind of rally. Now, it usually doesn't jump up this much in one day, but you could have a good few, maybe a few days to a week of good price action after something like this happening. Or the other way you could do it is wait for it to break to the upside and have a green candle close above the descending line on the wedge, which is the top part. And if you could get a good green candle above that towards the close of the day, probably be good to get in and ride it out for a few days. So again, I think that is how you can generally trade wedges. I think it's the great way to start off, from the get-go as a trader or investor, and it can really give you an advantage to know when price action is going to have some kind of big catalyst movement. So again, wedges themselves are very common in markets. You'll find them all over the place. And once you start using them, you'll start spotting them everywhere. You almost go crazy, like, oh, that's a wedge, that's a wedge. But again, don't try to make faulty wedges. This is a perfect example of a wedge right here, where the price action shows a clear technical indicator of coiling price action. So the next one I want to talk about is a bearish wedge, and this is what's known as a ascending wedge. Now, you might think that's kind of like, ironic. It's like ascending wedge. That sounds great. But an ascending wedge is not a good sign. It is a sign of weakness in price action, and it shows steady resistance. So what do I mean by that? Well, we can see here with the descending wedge, compared to a wedge where the price action, whether it's going downwards or upwards, was coiling inward, we do have a coiling inward here for waves, but there's something interesting that makes it different, okay? And this is the fact that with a ascending wedge, we can see that the support level is showing much higher strength from the bottom right here. It's continuing to rise up. But even with that support, the resistance is staying steady, okay? So it means that the resistance line, the line that is giving a form of resistance for the price action, is going to the side, and it's not moving up as fast as that support. So this shows signs of over exuberance in markets, okay? And when you see this kind of sign in price action, you see the breakthrough, and you start to see, the price action collapse below that supporting line, you can confirm this is most likely an ascending wedge and that there's some serious sell side coming, as we saw with waves. It just was too fast of a run up too quick. And that's usually what you find with ascending wedges. It's trying to maintain that price action, but the resistance is too strong. So that's a perfect example of it. It's a little bit rough in this case, but again, you can see the perfect support line here, trying to hold the price action too fast, too quick, and you could see that the resistance was too strong. The last one I want to talk about is a descending wedge. Now, much like an ascending wedge where it seems ironic, a descending wedge is very bullish, as you can see with the green lines here. So I want to go ahead and show you it's pretty much the opposite of a ascending wedge. A descending wedge is indicating bullish price action. It's showing positiveness to price action. And as we can see, the support line is dropping slower than the resistance line, okay? And this can indicate in a lot of cases that something's oversold and that it's ready for a breakout. Now, why is it this way, folks? Again, my interpretation might be relatively accurate. It's just how things work in markets. These technical indicators have been used on stocks, bonds, other types of forex in the sense of foreign exchange for currencies, and then in cryptocurrencies as well. And we can see that ARK had a fantastic rally here comparative to Bitcoin, as you could see, due to its lowering support line that lowered at a slower rate comparative to its resistance. And that generally is what a descending wedge is. Descending wedges can be great signs of something being oversold, something's ready for a breakout, and there's a lot of upside action to come to it. So again, keep an eye for descending wedges. I think these are great buying opportunities. Much like how ascending wedges can be times to get out, a descending wedge is a fantastic buying opportunity. Now keep in mind as well, sometimes things can be oversold, so don't always try to find descending wedges on things that have had reasons as to why they're going down. But usually with descending wedges, you have slowing sell side action in the sense of lowering lows. So you really shouldn't be seeing something that's dramatically oversold showing a descending wedge. If that were the case, it would just simply collapse through, and there would be no descending wedge. So this can show that in a lot of cases, something has generally been oversold, and it's maintaining generally the same support level as it slows down, whereas the resistance is dropping down way too quick. So again, coiling price action, waiting for a breakout. This is generally how you use wedges, folks. They're really great tools, and I recommend you learn how to use them because whether you're trading or investing, they can be a great tool to help you spot price action for the future and to make trades before the big movements happen. That's it for the video, everyone. I hope you all appreciated my topic on wedges, and I hope you'll use them in your trading as well. I think there's some of the best patterns you can use out there in trading for cryptocurrencies, especially as a beginner. But again, if you all have a technical indicator, you have a trading strategy you want me to cover, or a pattern of price action that you want me to talk about on this channel, you let me know down in the comments down below. I love getting your feedback. And until then, everyone, I will see you all in the next video. Stay tuned.